A sell-off is one of the most important market conditions for traders to understand, especially when trading SPY. A sell-off happens when sellers take control of the market and push price lower through weakening structure, breakdowns, or strong bearish reversals. Some sell-offs develop slowly as buyers gradually lose control, while others happen quickly with aggressive momentum and emotional selling pressure. Understanding how a sell-off forms can help traders avoid entering too late and recognize when bearish momentum is actually building. A typical sell-off begins with a weakness or distribution phase. This is when price starts losing strength after a consolidation period or after a failed attempt to continue higher. Buyers are no longer pushing price effectively, and sellers begin stepping in. The next stage is the breakdown trigger. This occurs when SPY breaks below an important support level, trading range, or intraday structure zone. A clean break below support often signals that sellers are gaining control. After the breakdown, the expansion phase begins. This is where bearish momentum accelerates and price moves lower quickly. Strong selling pressure creates larger downside candles and pushes SPY away from the broken support area. During a sell-off, traders will often see temporary pullbacks or relief bounces. These moves can appear convincing, but if sellers remain in control, these bounces usually fail and price continues lower. Strong sell-offs usually have several key characteristics. They create consistent lower highs and lower lows, showing that sellers continue to dominate. They break important support levels with strength and follow through with strong bearish momentum. Another important sign is failed recovery attempts. When SPY breaks support and then struggles to reclaim that level, the old support often becomes new resistance. However, not every breakdown turns into a true sell-off. Weak sell-offs can become traps for traders who enter too early. Warning signs include quick rejections after breaking support, aggressive bounces back above key levels, choppy price action, and a lack of continued downside momentum. A failed breakdown can quickly reverse and push price back into the previous trading range, trapping traders who chase the move lower. When analyzing a potential sell-off, focus on 4 key areas. First, look at the strength of the breakdown. Was support broken cleanly, or was it only a temporary move? Second, watch downside momentum. Is selling pressure increasing, or is price struggling to continue lower? Third, pay attention to relief bounces. Are they being aggressively sold, or are buyers successfully taking back control? Finally, watch whether new resistance forms below the broken support level. The most important reminder is that sell-offs are not guaranteed continuation moves. A market can break down and still reverse. Always consider the broader market structure, support and resistance levels, the overall trend environment, and clear entry confirmation before taking a trade. Sell-offs are not random market drops. They are structured breakdowns where sellers gain control, momentum expands, and price moves through important technical levels. Understanding this behavior helps traders avoid chasing late moves and improves their ability to recognize higher quality bearish opportunities with better timing and confirmation.